The most dangerous time to be fully invested in stocks is when stocks have been going up for years and everyone thinks they'll go up forever. The safest time to own bonds is when everyone thinks bonds are dead and interest rates have nowhere to go but up. I've lived through enough cycles to know this pattern, and right now, I'm seeing it again. People are piling into equities. They're chasing yield in private credit. They're buying crypto because it's the future. And I'm sitting here with 40% of my wealth in the most boring assets imaginable, sleeping like a baby, knowing that when the next crisis hits, and it will hit, I'll have the capital to buy when everyone else is forced to sell. Before we go deeper into this, if you value this kind of institutional-grade market perspective delivered without the hype, please take a moment to like this video and subscribe to the channel with notifications turned on. It genuinely helps us reach more people who need to hear a different perspective on risk. Now, I want to be very clear about what I'm not saying. I'm not predicting a crash. I'm not telling you to sell everything and go to cash. I'm not claiming to know what happens next month or next quarter or even next year. What I am saying is that risk and perception of risk are inversely correlated. When everyone feels safe, that's when you're in the most danger. When everyone feels terrified, that's when the real opportunities emerge. And right now, we're in one of those periods where complacency has become consensus, and consensus is expensive. Let me tell you what I'm seeing across the markets I monitor every single day. Equity valuations in the US are at levels we've only seen a handful of times in history. The cyclically adjusted price-to-earnings ratio, the CAPE ratio, is above 30. The only times it's been higher were 1929, right before the Great Depression, and 1999, right before the dot-com crash. Does that mean we're about to crash? No. It means we're priced for perfection. It means there's very little margin for error. It means that if earnings disappoint, if interest rates surprise, if geopolitics escalates, the downside is asymmetric. And yet, I talk to investors every week who are 80%, 90%, sometimes 100% in equities. They tell me bonds are pointless because yields were so low for so long. They tell me cash is trash because inflation erodes it. They tell me you have to take risk to get returns. And all of that was true in a zero-rate environment. But we're not in a zero-rate environment anymore. We haven't been for years. And the assumptions people are operating under are increasingly disconnected from the reality of where we are in the cycle. Here's what most people miss about cycles. They don't turn when the fundamentals deteriorate. They turn when perception shifts. The fundamentals can look great right up until the moment they don't. Earnings can be strong. Employment can be solid. GDP growth can be positive. And then something breaks. A bank fails. A geopolitical event escalates. A policy mistake gets made. And suddenly, all the leverage in the system, all the risk that was taken assuming good times would continue, all of that becomes a problem. I saw this in 2008. In early 2007, everyone thought housing prices would keep going up. Subprime mortgages were considered safe because they were diversified and rated AAA. The models said everything was fine. And then it wasn't. The system was so interconnected, so leveraged, so dependent on things continuing to work, that when one piece failed, the whole structure came down. People lost half their wealth in 18 months. Retirements were destroyed, and the people who survived weren't the ones with the best stock-picking skills. They were the ones who had liquidity, who had dry powder, who weren't forced to sell at the bottom. I also saw it in 2000. The dot-com bubble. Everyone believed the internet was going to change everything, and they were right. The internet did change everything. But that didn't mean every internet stock was worth owning at any price. Valuations got completely detached from reality. And when the bubble burst, the Nasdaq fell 78% from peak to trough. It took 15 years to get back to those highs. If you were fully invested in tech stocks in March 2000, you experienced a generational destruction of wealth. But if you had bonds, if you had cash, if you had the discipline to stay diversified, you survived. And more importantly, you had capital to deploy when things got cheap. Right now, I'm not seeing 2008 levels of systemic fragility. I'm not seeing 2000 levels of speculative mania across the entire market. But I am seeing pockets of it. I'm seeing private credit funds raising billions with minimal transparency and covenant-light structures that terrify me. I'm seeing retail investors piling into leveraged ETFs because they think they can time short-term moves. I'm seeing crypto treated as a serious asset class by people who can't explain the underlying technology or the value proposition beyond number go up. And I'm seeing something more fundamental. I'm seeing an entire generation of investors who have never experienced a real bear market. If you started investing after 2009, You've lived through one of the longest bull markets in history. You've been trained to buy every dip because every dip has been followed by new highs. You've been rewarded for taking risk and punished for being cautious. And that's created a psychological framework where caution feels like a mistake and risk feels like prudence. That's incredibly dangerous. Let me explain what I mean by having 40% of my wealth in boring assets. I'm talking about short-term U.S. Treasuries. I'm talking about investment-grade corporate bonds with maturities under 5 years. I'm talking about Treasury inflation-protected securities that adjust for inflation and guarantee I don't lose purchasing power. These are not exciting. They don't generate headlines. They don't make cocktail party conversation. But they do something that's more valuable than excitement. They preserve capital and generate optionality. When I hold 40% in these assets, I'm not trying to maximize my returns in the next 12 months. I'm managing the risk of the next 12 years. I'm ensuring that if we have a significant drawdown, I'm not forced to sell equities at depressed prices. I'm ensuring that I have capital available to buy when assets are on sale. I'm ensuring that my portfolio can withstand shocks without requiring me to make emotional decisions under duress. That's risk management. That's how institutions think. And it's how individuals should think if they want to build wealth that lasts across cycles. Here's what people don't understand about opportunity cost. When you're fully invested in equities and the market goes up 10%, you feel like a genius. When you're 60% equities and 40% bonds and the market goes up 10%, you feel like you're missing out because you only captured 6% of that upside. But when the market goes down 30%, and you're fully invested, you're down 30%. When you're 60/40ths, you're down maybe 15% to 18%. And here's the critical part. It's much easier psychologically and mathematically to recover from an 18% loss than a 30% loss. If you lose 30%, you need a 43% gain just to get back to even. If you lose 18%, you need a 22% gain. That difference is enormous over time. And more importantly, when you have that 40% in stable assets during a downturn, you can rebalance. You can sell some of those bonds and buy equities when they're cheap. You're buying low because you have the capital to do so. The person who was 100% equities doesn't have that option. They're just hoping and praying for a recovery while watching their account shrink. I learned this lesson the hard way early in my career. Before I started BlackRock, I was at First Boston. We were trading mortgage-backed securities, and we thought we had it all figured out. We had models. We had risk controls. We thought we understood the market. And then interest rates moved in a way we didn't expect, and we lost a lot of money. Not because we were stupid, but because we were overconfident. We had too much exposure to a single scenario. We didn't have enough dry powder to weather volatility. That experience shaped everything I did afterwards. When I started BlackRock in 1988, one of our core principles was risk management. Not risk avoidance, risk management. We built systems, we developed technology, we created processes to understand and quantify risk across every dimension of our portfolios. And what we learned, over and over again, is that the biggest risks aren't the ones you can model. They're the ones you don't see coming. The tail events. The things that models say should happen once every 100 years but seem to happen every decade. So we built portfolios with buffers. We maintained liquidity. We diversified not just across asset classes, but across risk factors. We assumed that at some point, something unexpected would happen, and we wanted to be in a position to survive it and capitalize on it. That mindset, more than any single investment decision, is why BlackRock has been successful over nearly 4 decades. We respected risk. We didn't fear it, but we respected it. Now, let me talk about what I'm seeing in investor behavior right now, because it worries me. I'm seeing people treat risk assets like they're guaranteed to go up. I'm seeing financial advisors putting retirees in 80% equity allocations because stocks outperform over the long term. I'm seeing young investors taking out loans to buy assets because you have to leverage to get ahead. All of this is risk-taking without risk awareness. It's assuming the future will look like the recent past. And that assumption is almost always wrong at turning points. Here's a question I ask people. What would happen to your portfolio if we had a repeat of 2008? Not a prediction, just a scenario. If equities fell 50%, if credit spreads blew out, if liquidity dried up, what would your portfolio look like? Would you be forced to sell? Would you panic? Would you have the psychological resilience to hold on and the financial capacity to not need the money? Most people can't answer that question because they've never stress tested their portfolio. They've just ridden the wave up and assumed the wave will keep going. Institutional investors don't think that way. When I meet with the CIO of a pension fund, we don't talk about what happens if things go well. We talk about what happens if things go badly. We model recessions. We model inflation shocks. We model geopolitical crises. We figure out how the portfolio performs in adverse scenarios, and we make sure it's structured to survive those scenarios. That's the baseline. Only after we've ensured survival do we optimize for returns. You should do the same thing with your personal portfolio. Not obsess over worst-case scenarios, but at least understand them. Know what a 30% drawdown would mean for you. Know what a prolonged period of low returns would mean. Know whether you could handle the emotional stress of watching your account value drop by a third. And if the honest answer is no, then you're taking too much risk. Period. It doesn't matter what your advisor says. It doesn't matter what the historical averages are. If you can't psychologically or financially afford the downside, you shouldn't be taking the risk. Here's the other thing I'm seeing. Recency bias. People think the last 10 years are predictive of the next 10 years. They're not. Every cycle is different. The forces driving markets today are not the same as the forces that drove them over the last decade. We had zero interest rates for most of that period. We had quantitative easing pumping trillions into the system. We had fiscal stimulus on a scale we'd never seen before. All of that created tailwinds for risk assets. Those tailwinds are gone. In fact, in some cases, they've reversed. We have higher rates. We have quantitative tightening. We have fiscal constraints. The environment is different, and the assumptions people made in the old environment don't necessarily hold in the new one. But here's what hasn't changed. Human psychology. Fear and greed still drive markets. Herding behavior still creates bubbles and crashes. Overconfidence still leads to excessive risk-taking. And humility, discipline, and patience still generate better outcomes over time. The fundamentals of sound investing, the stuff that worked in the 1970s and the 1990s and the 2000s, that still works. Diversification still works. Cost control still works. Long-term thinking still works. Staying humble in the face of uncertainty still works. So when I say I have 40% of my wealth in boring assets, I'm not making a market call. I'm acknowledging uncertainty. I'm acknowledging that I don't know what happens next. I'm acknowledging that markets can stay irrational longer than I can stay solvent if I'm on the wrong side of a trade. I'm acknowledging that preservation of capital is as important as growth of capital, especially when you already have capital to preserve. And here's the thing that I think gets lost in all the noise. You don't have to choose between prudence and performance. You can own equities and own bonds. You can pursue growth and manage risk. You can be optimistic about the long term and cautious about the short term. These aren't contradictions. They're balance. And balance is what survives cycles. I've been doing this for almost 50 years. I've managed money through stagflation, through the crash of 1987, through the savings and loan crisis, through the dot-com bubble, through 9/11, through the financial crisis, through the European debt crisis, through the pandemic. And the pattern is always the same. When everyone feels safe, risk is building. When everyone feels terrified, opportunity is building. The crowd is almost always wrong at the extremes. And right now, the crowd feels pretty comfortable. They shouldn't. In the next section, I'm going to walk you through exactly how I think about portfolio construction in this environment. I'm going to explain the math behind why diversification isn't just about reducing volatility, it's about creating optionality. I'm going to show you how institutions allocate capital across cycles and why the strategies that work for billion-dollar portfolios also work for individual investors. And I'm going to give you a framework for thinking about risk that goes beyond just volatility or drawdowns and gets to the heart of what actually keeps you up at night. But before we get there, I need you to internalize one thing. The goal is not to predict the future. The goal is to build a portfolio that can handle multiple futures. A portfolio that does okay if I'm wrong about everything. A portfolio that gives me the ability to act rather than react when conditions change. That's the difference between speculation and investing. Speculation is betting on a specific outcome. Investing is positioning for a range of outcomes while managing the downside of being wrong. Let me show you how institutional investors think about portfolio construction, because the principles are universal even if the scale is different. When BlackRock builds a portfolio for a pension fund or a sovereign wealth fund, we don't start by asking what's going to generate the highest returns. We start by asking what are the constraints, what are the liabilities, and what are the scenarios that would cause catastrophic outcomes. Only after we understand those do we optimize for returns. Here's the framework. Every portfolio exists to serve a purpose. For a pension fund, that purpose is to pay retirement benefits for the next 30 or 40 years. For an endowment, it's to fund operations in perpetuity. For an individual, it might be to retire at 65 with a certain standard of living, or to fund a child's education, or to leave a legacy. The purpose defines the constraints. And the constraints define the acceptable level of risk. Most people do this backwards. They start with returns. They ask, how do I make the most money? And then they build a portfolio to maximize that number without really thinking about what they're risking to get there. That's not investing. That's gambling with extra steps. Investing starts with understanding what you can't afford to lose, and then building a structure that protects against those unacceptable outcomes while still allowing for growth. So let's talk about what unacceptable outcomes look like. For a 60-year-old who's about to retire with $1 million, an unacceptable outcome is a 40% drawdown in the first 2 years of retirement. Why? Because of something called sequence of returns risk. If you retire into a bear market and you're withdrawing money to live on, you're selling assets at depressed prices. You're permanently reducing the capital base of your portfolio. And even if markets recover, you may never catch up because you've locked in those losses through forced withdrawals. This happened to people who retired in 2007 and 2008. They had saved responsibly. They had million-dollar portfolios. They planned to withdraw 4% a year, which was supposed to be safe. And then the market fell 50%. Suddenly their million-dollar portfolio was worth $500,000, and they still needed $40,000 a year to live on. That's an 8% withdrawal rate, which is unsustainable. Many of those people had to go back to work, or drastically cut their standard of living, or both. That's a catastrophic outcome, and it could have been avoided with proper risk management. Here's what proper risk management looks like. You identify your non-negotiable cash needs for the next 5 to 7 years. Let's say it's $50,000 a year. That's $250,000 to $350,000. You put that money in short-term bonds, tips, money market funds, things that don't correlate with stocks and won't lose value when stocks crash. That money is off the table. It's not participating in equity upside, but it's also not participating in equity downside. It's your insurance policy. It's what allows you to not sell stocks in a bear market. The rest of your portfolio, the portion you don't need for 5 to 7 years, that can be in growth assets. Stocks, real estate, even some alternatives if you have the sophistication and the access. Because you have time. If there's a downturn, you can wait it out. You're not forced to sell. You can live off that bond ladder while you wait for equities to recover. That's how you survive sequence of returns risk. That's how you ensure that a market crash doesn't derail your entire retirement. Now, for younger investors, the math is different but the principles are the same. If you're 30 years old and you're saving for retirement, a 40% stock market crash is not a catastrophic outcome. It's an opportunity. You have 35 years until you need the money. You should be hoping for a crash so you can buy more shares at lower prices. Your risk is not market volatility. Your risk is not saving enough, or panicking and selling at the bottom, or chasing performance and paying too much in fees. Those are the risks that will derail you, not short-term market fluctuations. But here's what I see. Young people in cash, older people in equities. It's backwards. The 25-year-old who should be 90% stocks is sitting in a high-yield savings account because they're scared of volatility. The 65-year-old who should be building a bond ladder is 80% in growth stocks because they've been conditioned by a decade-long bull market to think stocks only go up. Both are making mistakes based on recent experience rather than structural understanding of risk. Let me talk about how we think about diversification at the institutional level, because most people misunderstand what diversification actually does. Diversification is not about maximizing returns. It's about minimizing regret. It's about building a portfolio where no single decision, no single asset class, no single bet determines your outcome. You want to be diversified enough that you're never completely wrong, but concentrated enough that you can still benefit when you're right. The old model was 60% stocks, 40% bonds. And for a long time, that worked because stocks and bonds were negatively correlated. When stocks went down, bonds went up, or at least stayed stable. The portfolio balanced itself. But in 2022, that correlation broke. Inflation surged, the Fed raised rates aggressively, and both stocks and bonds fell at the same time. The 60/40ths portfolio was down over 15%, which wasn't supposed to happen. People who thought they were diversified got hurt because the assumptions underlying their diversification were wrong. This is why I've been advocating for a different model: 50% stocks, 30% bonds, 20% alternatives. The alternatives bucket includes real estate, infrastructure, private credit, commodities, things that have different drivers than public equities and fixed income. These assets don't move in lockstep with the stock market. When public markets are volatile, infrastructure assets like toll roads or power grids or data centers keep generating cash flow. When inflation spikes, commodities and real assets tend to hold their value or even appreciate. That's true diversification. Not just different asset classes, but different risk factors. Now, I know what you're thinking. Larry, I'm not a pension fund. I don't have access to infrastructure funds or private credit vehicles. And that's partially true, but it's changing. At BlackRock, we've been working to democratize access to these asset classes. We've built products that allow individual investors to get exposure to private markets, to real assets, to strategies that used to be locked behind institutional gates. It's not perfect yet. The minimums are still high for some of these products. The liquidity is different, but the direction is clear. These assets are becoming more accessible, and investors who understand their value will benefit. Let me give you a concrete example of how this plays out. In 2020, during the pandemic crash, public equities fell 34% in 5 weeks. If you were 100% in stocks, you were down 34%. If you were in a traditional 60/40 portfolio, you were down about 20% to 22%. But if you had 20% in real assets, infrastructure, things that weren't correlated to the panic in public markets, you were down closer to 15%. That's a meaningful difference. And more importantly, the recovery was different. The public markets bounced back quickly because of Fed intervention. But infrastructure kept generating cash the whole time. There was no drawdown to recover from in that bucket. It was just steady cash flow. That steady cash flow is psychologically important. When you see your overall portfolio down 15% instead of 34%, when you see one part of your portfolio continuing to pay you income even while another part is volatile, it's easier to stay disciplined. You're less likely to panic. You're less likely to sell at the bottom. And that behavioral stability is worth more than the mathematical benefit of diversification. It's what keeps you invested through downturns, which is the single most important determinant of long-term success. Now let's talk about the specific boring assets I mentioned having 40% of my wealth in, because there's a method to this. I don't just have 40% in bonds. I have a ladder of short-term treasuries, TIPS, and investment-grade corporate bonds with different maturities and different purposes. Each piece does something specific. Short-term treasuries, 1 to 3 year maturities, are my liquidity buffer. If I need cash in the next year or two, I can sell these with minimal interest rate risk. They're not going to generate significant returns, but they're also not going to lose value if interest rates move. Their stability, their optionality, they're the reason I can afford to be patient with my equity positions. TIPS, Treasury Inflation-Protected Securities, are my inflation hedge. If inflation runs hot, the principal value of these bonds adjusts upward. I maintain purchasing power. I'm not getting rich off TIPS, but I'm also not getting slowly impoverished by inflation eating away at my fixed income. In an environment where inflation is uncertain, where central banks are still figuring out the right policy stance, TIPS are insurance that pays you to own it. Investment-grade corporate bonds, 3 to 5 year maturities, are where I get a little more yield. These are bonds from solid companies with strong balance sheets. Not junk, not speculative, just high-quality corporates. They pay more than treasuries because there's credit risk, but that risk is manageable if you're diversified across issuers and sectors. And if we go into a recession, yes, corporate bonds will underperform treasuries, but they won't collapse the way equities might. They're a middle ground between safety and return. This structure, this laddering approach, it's how institutions manage fixed income. You don't put all your bonds at one maturity. You spread them out. Every year, some bonds mature and you reinvest at current rates. If rates are higher, you benefit. If rates are lower, you already locked in higher yields earlier. It smooths out interest rate risk over time. And it creates a predictable cash flow stream that you can plan around. Here's the math that most people miss. Let's say you have $1 million and you put 40% in this bond structure. That's $400,000 generating, let's say, 4% to 5% depending on the current rate environment. That's $16,000 to $20,000 a year in income. Not exciting, but meaningful. And critically, That income is not correlated to stock market performance. It's contractual. It shows up whether stocks are up or down. Now let's say stocks crash 30%. Your $600,000 in equities is now worth $420,000. Your total portfolio is $820,000. You're down 18% from the peak. That's painful, but it's not catastrophic. And here's where it gets interesting. You take some of that $400,000 in bonds and you rebalance. You sell $100,000 of bonds and buy $100,000 of stocks while they're down 30%. You're buying low. You're enforcing discipline through a mechanical process. You're not trying to time the bottom. You're just restoring your target allocation. When stocks recover, and they will, you benefit disproportionately from the shares you bought at depressed prices. That $100,000 you invested when stocks were down 30% grows faster than the shares you already owned. You've turned a crisis into an opportunity. And you were only able to do that because you had dry powder. You had capital that wasn't fully invested in risk assets. This is the strategy that institutional investors use. It's called rebalancing, but it's more than just rebalancing. It's a systematic way of buying low and selling high without having to predict market movements. When your equity allocation gets too high because stocks have run up, you sell some and buy bonds. When your equity allocation gets too low because stocks have fallen, you sell bonds and buy stocks. You're always moving against the crowd. You're always taking the other side of emotional trades. Now let me address the objection I hear constantly. But Larry, if I'm 40% in bonds, I'm giving up so much upside. If stocks go up 20%, I only capture 12% of that gain. That's opportunity cost. And yes, mathematically, that's true. In a raging bull market, a 60/40 portfolio will underperform a 100% equity portfolio. No question. But here's what people forget. That opportunity cost is actually the cost of insurance. You're paying a premium, in the form of lower upside capture, to insure against catastrophic downside. Just like you pay for car insurance even though you hope never to use it, you hold bonds even though you hope stocks keep going up. And the value of that insurance becomes apparent only when you need it. When the crash comes, when your neighbor who was 100% in stocks is down 40% and panicking, you're down 20% and calm. That calmness, that ability to act rationally when others are losing their minds, that's worth more than the upside you gave up. There's also a behavioral dimension that's hard to quantify but critically important. If you're 100% in equities and stocks fall 30%, how will you react? Will you hold? Will you buy more? Or will you panic and sell? Be honest. Most people panic. Most people can't handle watching their life savings drop by a third. They intellectually understand that they should hold long term, but emotionally, they can't do it. So they sell. They lock in the loss. They miss the recovery. And they end up far worse off than if they just held a balanced portfolio that they could psychologically handle. This is why I always say the best portfolio is not the one with the highest expected return. It's the one you can stick with through a full market cycle. If a 100% equity portfolio is theoretically optimal but you're going to panic and sell when it drops 40%, then it's not optimal for you. A 60/40 portfolio that you can hold through the drawdown is better, even if the mathematical expected return is lower, because you'll actually capture the returns rather than bailing out at the worst possible time. Let me give you another institutional concept: risk budgeting. Institutions don't think about returns in isolation. They think about returns per unit of risk. If strategy A generates 10% returns with 15% volatility, and strategy B generates 8% returns with 8% volatility, which is better? It depends on your risk budget. If you can't afford 15% volatility, then strategy B is better for you even though the raw return is lower. Most individual investors don't think this way. They chase the highest return without considering what risk they're taking to get there. They see a fund that returned 30% last year and they want in, without asking how volatile it was, how much leverage it used, what tail risks it's exposed to. That's return seeking without risk awareness. It works great in bull markets and destroys wealth in bear markets. Here's my approach. I determine how much volatility I can emotionally and financially handle. Let's say it's 20% annualized volatility. Then I build a portfolio that stays within that volatility budget while maximizing expected returns. If I can get 8% expected return with 15% volatility, that's better risk-adjusted performance than 10% return with 25% volatility. I'm optimizing for the Sharpe ratio, returns per unit of risk, not just raw returns. This requires thinking in terms of probability distributions, not point estimates. I don't ask, what will this portfolio return? I ask, what's the range of possible outcomes, and what's the probability of each? I model the 10th percentile outcome, the scenario where almost everything goes wrong. Can I survive that? If yes, then I can take the risk. If no, I need to dial back the risk exposure. This is why I'm comfortable having 40% in boring assets. I've modeled the scenarios. I know what happens if stocks crash 50%. I know what happens if inflation spikes to 8%. I know what happens if we have a prolonged recession with stagflation. In all of those scenarios, my portfolio survives. It doesn't thrive, but it survives. And survival is the prerequisite for eventual success. You can't compound wealth if you blow up. So let me bring this all together and give you a framework you can actually use. Not a prediction about where markets are going, not a specific allocation that works for everyone, but a way of thinking about risk and opportunity that will serve you across every market environment for the rest of your investing life. First principle. Your asset allocation should reflect your personal risk budget, not market conditions. This is where most people get it wrong. They adjust their portfolio based on what's happening in markets rather than what's happening in their own life. When stocks are up, they get more aggressive. When stocks are down, they get more conservative. That's backwards. That's emotional decision-making masquerading as strategy. Here's how to think about it correctly. You have a certain amount of risk capacity and a certain amount of risk tolerance. Risk capacity is objective. It's determined by your time horizon, your income stability, your financial obligations, and your alternative sources of capital. If you're 30 years old with a stable job and no dependents, you have high risk capacity. You can afford to be aggressive. If you're 65 with no pension and $1 million portfolio that needs to last 30 years, you have lower risk capacity. You need stability. Risk tolerance is subjective. It's psychological. Some people can watch their portfolio drop 30% and sleep fine. Other people can't handle a 10% drawdown without panicking. Neither is right or wrong. It's just who you are. And your portfolio needs to respect both your capacity and your tolerance. If your capacity suggests 80% equities but your tolerance can only handle 60%, go with 60%. A portfolio you can stick with at 60% equities is better than a portfolio you'll abandon at 80% equities. Once you've determined your personal allocation, you stick with it. You don't change it because stocks have been going up for 3 years. You don't change it because everyone is piling into crypto. You don't change it because some guru on YouTube says bonds are dead. You change it only when your personal circumstances change. You get closer to retirement, you dial down risk. You receive an inheritance, maybe you can take a bit more risk. You lose your job, you get more conservative. But these changes are driven by your life, not by market movements. Second principle. Rebalancing is not optional. It's the mechanism that enforces discipline. Here's how it works in practice. Let's say your target allocation is 60% stocks, 30% bonds, 10% alternatives. At the beginning of the year, you set that allocation. 6 months later, stocks have rallied and now they're 68% of your portfolio. Bonds are down to 26%. Alternatives are 6%. You're overweight equities and underweight bonds. What do? You rebalance. You sell enough stocks to get back to 60%. You buy bonds to get back to 30%. You might add to alternatives to get back to 10%. This feels uncomfortable because you're selling the thing that's been going up and buying the thing that's been flat or down. Every psychological instinct says to do the opposite. But this is exactly the right move. You're systematically selling high and buying low. You're taking profits from the overvalued asset and deploying them to the undervalued asset. And here's the beautiful part. You do this mechanically. You don't need to predict whether stocks will keep going up or start coming down. You don't need to have a view on bond yields or inflation or anything else. You just rebalance to your target allocation. When stocks are expensive relative to your target, you sell some. When they're cheap, you buy some. Over time, this process adds 0.5% to 1% annually to your returns compared to a buy and hold strategy with no rebalancing. That's not from brilliant analysis. That's from discipline. I recommend rebalancing quarterly or annually. More frequent than that and you're triggering unnecessary taxes and trading costs. Less frequent and you're allowing dangerous drifts to develop. Quarterly is probably optimal for most people. Set a calendar reminder. Check your allocation. If anything is more than 5 percentage points off target, rebalance. Otherwise, leave it alone. Third principle. Prepare for regret, don't try to avoid it. This is subtle but important. No matter what you do, you're going to regret something. If your 40% bonds and stocks go up 30%, you're going to regret not being more aggressive. If you're 100% stocks and they crash 40%, you're going to regret not having bonds. Regret is unavoidable. The question is, which regret can you live with? I can live with missing some upside. I can't live with catastrophic losses. So I structure my portfolio to avoid the regret I can't handle, even though it means accepting the regret I can handle. Some people are wired differently. They'd rather take big swings and occasionally strike out than play it safe and miss the home run. Fine. But you need to know which type you are, and you need to build a portfolio that matches your regret tolerance, not just your return expectations. Here's a thought experiment. Imagine two scenarios. In scenario A, you're 100% in stocks, they go up 25% this year, and you feel like a genius. In scenario B, you're 60/40ths, stocks go up 25%, and you only capture 15% of that gain. You feel like you missed out. Which scenario would bother you more? Now imagine two different scenarios. In scenario C, you're 100% in stocks, they crash 40%, and you're devastated. In scenario D, you're 60/40ths, stocks crash 40%, your portfolio is down 24%, and you're hurt but okay. Which scenario would bother you more? If scenario B bothers you more than scenario C, you should be aggressive. If scenario C bothers you more than scenario B, you should be balanced or conservative. Most people don't think about this explicitly, but they should. Understanding your own psychology around regret is as important as understanding expected returns. Fourth principle. Liquidity is a strategic asset, not a return drag. When I say I have 40% in boring assets, part of what I'm buying is liquidity. The ability to act when others can't. The ability to rebalance during volatility. The ability to take advantage of dislocations. This has value even though it doesn't show up in year-to-year returns. Think about 2008. If you were 100% in illiquid assets, private equity, real estate partnerships, hedge funds with lockups, you were stuck. You couldn't rebalance. You couldn't sell something that was down less to buy something that was down more. You just had to ride it out. But if you had 30% or 40% in liquid bonds, you had options. You could rotate into equities when they were down 50%. You could buy real estate when forced sellers were desperate. You could be greedy when others were fearful, but only because you had liquid capital. This is why institutions maintain liquidity buffers even though it reduces short-term returns. They know that crises create opportunities, and opportunities require capital. If all your capital is already deployed, you can't take advantage. You're just holding on and hoping. But if you have dry powder, you can be strategic. You can deploy during dislocation. And the returns you generate during those periods often exceed what you gave up by holding lower-yielding assets during normal times. Fifth principle. Understand the difference between risk and uncertainty. Risk is something you can measure and model. Stock market volatility is risk. You can look at historical distributions, calculate standard deviations, model drawdowns. Uncertainty is different. Uncertainty is the stuff you can't model. The pandemic, the geopolitical event nobody saw coming, the policy mistake, the technological disruption. You can manage risk through diversification and position sizing. You manage uncertainty through humility and optionality. You acknowledge that your models are incomplete. You maintain flexibility. You avoid excessive concentration. You keep some capital in assets that aren't correlated with your core views. You build a portfolio that survives scenarios you haven't thought of, not just scenarios you've modeled. This is why I'm skeptical of overly complex portfolio optimization models. They take historical data, they calculate optimal weights, they spit out an allocation that maximizes expected return for a given level of volatility. And it all looks very scientific. But it's based on assumptions about correlations and distributions that hold true until they don't. In 2008, correlations that had been stable for decades broke down. In 2022, the negative correlation between stocks and bonds disappeared. The model said it shouldn't happen. It happened anyway. So yes, use models. Use analytics. Use data. But don't be enslaved by them. Leave room for judgment. Leave room for the possibility that the future will be different from the past. That's what humility means in an investing context. It means acknowledging the limits of your knowledge and structuring your portfolio to survive being wrong about things you're confident about. Sixth principle. The goal is not to beat the market. It's to meet your objectives. This is a massive mindset shift that most people never make. They compare their portfolio to the S&P 500. If the S&P is up 20% and they're only up 12%, they feel like they failed. But that's the wrong benchmark. The right question is, are you on track to meet your goals? If you need 6% annually to retire comfortably and you're generating 8%, you're winning. It doesn't matter that the S&P did 20%. You don't need 20%. You need 6%, and you're exceeding it with less risk. That's success. But if you need 6% and you're only getting 3%, then you have a problem. Even if the S&P is down, you're not meeting your objectives. This is how institutions think. A pension fund doesn't benchmark against the S&P. They benchmark against their liabilities. Can they pay the promised benefits? That's the only question that matters. If they can do it with 90% certainty by taking moderate risk, they're not going to swing for the fences to try for 95% certainty. The marginal benefit doesn't justify the marginal risk. You should adopt the same framework. Define what financial success looks like for you. Retiring at 65 with $80,000 annual income. Paying for your kids' college. Leaving $500,000 to charity. Whatever it is, define it. Then build a portfolio that has a high probability of achieving it. If you can get there with a 60/40 allocation, you don't need to be 100% equities. The extra risk doesn't serve a purpose. You're optimizing for something that doesn't matter to you. Now let me talk about what I'm actually doing with my portfolio right now, because I want to be transparent about how these principles play out in practice. I said I have 40% in boring assets. Here's the breakdown. About 15% is in short-term treasuries, 1 to 3 year maturities. This is pure liquidity. If I need cash for any reason, it's there. Another 15% is in tips, mostly intermediate maturities, 5 to 10 years. This is my inflation protection. The remaining 10% is in investment-grade corporate bonds, diversified across sectors, 3 to 7 year maturities. The other 60% is split between equities and alternatives. About 40% is in equity index funds, roughly 30% US and 10% international. I'm not trying to pick winners. I'm not making sector bets. I'm just owning the market, low cost, diversified. The remaining 20% is in alternatives. About half of that is in real estate, a mix of public rights and some direct real estate investments. The other half is in infrastructure and private credit, mostly through funds that BlackRock manages because I obviously have access to those. Is this the perfect allocation? No. There's no such thing as perfect. Is this right for you? Probably not. Your situation is different from mine. But it's right for me given my age, my risk tolerance, my objectives, and my view on current market conditions. And that's the point. The allocation itself is less important than the thought process behind it. I've modeled what happens to this portfolio in different scenarios. If stocks rally 20% and bonds are flat, I'm up about 10%. Not spectacular, but fine. If stocks crash 30% and bonds are up modestly, I'm down about 12% to 15%. Painful, but survivable. If we get stagflation, high inflation and low growth, my tips protect me on the inflation side and my real assets hold value. If we get deflation and recession, my treasuries do well and my equity losses are cushioned. I'm not optimized for any single scenario. I'm positioned for a range of scenarios. And critically, in all of those scenarios, I have liquidity to rebalance. If stocks crash, I can sell some bonds and buy equities at lower prices. If stocks surge, I can take some profits and buy more bonds. I'm never trapped. I'm never forced to act because of leverage or liquidity constraints. I can make strategic decisions rather than forced decisions. That optionality is worth more to me than trying to squeeze out an extra 1% or 2% of return. Here's what I want you to take away from this. Building a portfolio is not about predicting the future. It's about preparing for multiple futures. It's not about maximizing returns. It's about optimizing the trade-off between return and risk given your specific constraints and objectives. It's not about being clever. It's about being disciplined. And it's not about beating some external benchmark. It's about meeting your internal goals. The 40% I have in boring assets, it's not because I think stocks are about to crash. It's because I know they might crash, and I want to be prepared if they do. It's because I value the ability to sleep at night more than I value squeezing out the last bit of upside. It's because I've lived through enough cycles to know that the most dangerous words in investing are, "This time is different." It's never different. The specifics change, but the patterns remain. Greed leads to bubbles. Fear leads to crashes. Discipline leads to long-term wealth. So here's my challenge to you. Look at your portfolio, not with the question, what will give me the highest returns, but with the question, what can I stick with through a full market cycle? If you can honestly say you'd hold your current allocation through a 40% drawdown without panicking, fine. Keep it. But if you have any doubt, if you think you might sell in a crisis, then you're taking too much risk. Dial it back. Get more conservative. Build something you can live with emotionally, not just something that looks good on paper. And stress test your portfolio. Model the bad scenarios. What happens if stocks fall 50%? What happens if inflation goes to 8%? What happens if both happen at the same time? Can you survive those scenarios and still meet your objectives? If not, you need to adjust. If yes, then you have the right allocation, even if it means missing some upside in good times. Remember, the goal is not to be the richest person in the graveyard. The goal is to have enough to live the life you want without constantly worrying about money. That requires a different mindset than maximizing wealth. It requires thinking about sufficiency, about what enough looks like for you, and building a portfolio that gets you there with high confidence rather than a portfolio that might get you way past there but also might fall short. I've been doing this for nearly 50 years. I've made mistakes. I've learned lessons. I've refined my approach. And the biggest lesson is this. The investors who survive and thrive over decades are not the ones who take the most risk or generate the highest returns in any given year. They're the ones who understand their own psychology, who build portfolios they can stick with, who stay disciplined when markets get volatile, and who never bet everything on being right about any single view. That's why I sleep like a baby with 40% in boring assets. Not because I know what's going to happen next, but because I know that whatever happens next, I'll be okay. I'll have capital to deploy if there's opportunity. I'll have stability if there's volatility. I'll have options when others feel trapped. And that peace of mind, that financial and psychological flexibility, that's worth more than any incremental return. If you found this perspective valuable, if it challenged the way you think about risk and portfolio construction, please share this video with someone who needs to hear it. Like it, subscribe to the channel, and engage in the comments. Tell me what your allocation is and why. Tell me how you think about these trade-offs. Because the more we can have honest conversations about risk, about uncertainty, about what actually drives long-term success, the better off we'll all be. The market doesn't care about your opinions or mine. It doesn't care about confidence or conviction. It just does what it does. Your job is to build a portfolio that can handle what it does, whatever that turns out to be. Start there. Everything else is secondary.